Hey guys, it's Cameron here with Emerson House Buyers. Every week I bring you tools, tactics, strategies, lessons I've learned, things that helped me build up a sizable loan portfolio in about 2 years. A recent video just put out was regarding the tax benefits that I received last year in 2017 for owning my rental properties and how I actually have a negative adjusted gross income. I had some questions about that. It was actually a very popular video. If you haven't seen it, check it out in one of the upper corners here. So I had a bunch of questions. Oh, what's going on? Now, guys, I am not a CPA, so take this. This is just what I've learned and what I was able to do with my CPA. Highly advise you to get one. There's numerous reasons to do it. One, they might know more stuff than what I'm about to tell you. Maybe there's something local where you're at. There's a different write-off that you can use. Number two, they take some of the liability. If you structure it correctly with your CPA, if you are audited and you owe something, there is a clause, if you do it right, speak with them about this, that if you get audited, they will front the bill on that. So instead of you coming up with $30,000 or $40,000, they do. They make, now it's they're very meticulous on how they go through things. You have to provide a lot of documentation. That doesn't mean you can just say, yeah, I install this 50 grand here, 20 grand there, and not do it. You have to do everything by the books. But what I'm saying is it gives you a little bit more comfort sleeping at night than doing it on TurboTax and being all nervous about it. Because some of these things have limits and what have you. So, got a list here. 10. 10. I don't know what that was. 10 tax benefits for owners of rental properties. Number one, interest. Hope you guys can read my handwriting. Interest. So, on your, if you have a mortgage on the property, or let's just say you borrowed money from mom, dad, a friend, whoever, private lender, they should, at the end of the year, provide you with the interest paid. Now, if it's a private lender, mom, dad, they're probably not going to do this, but mortgage companies by law have to send you something that's called a 1098. A 1098 form. Let's just write it on here. 1098. A 1098 form at the end of the year will tell you how much money, when you send a mortgage payment in of $500 or $1,000, how much of that was actually interest. So at the end of the year, it'll tell you how much interest is paid. Now, again, what's helped me, guys, is I have all these properties, and so I have interest on every single one. So I might only have $2,000 a year on this one. I might have $1,500 a year on this one. I might have $2,000 on this one, $3,000, $4,000. And then you add them all up, and I've got $15,000 or $20,000 in just interest deduction. So, number one, interest deduction, 1098. If it's a private, it doesn't, again, this doesn't have to just be for a mortgage. This could be for a business loan, which means, hey, mom, dad, help me out. I'm paying them interest, just interest-only loan. All those interests, as long as you keep records, which if you have a credit card or a checking account, you should be doing everything through that anyways. Don't do anything cash. Then you should have a record and you should be okay. Number two, what did I write down here? Depreciation. I'll write down another key number here. So depreciation. Now, if you can see, I wrote down something. It's called, I guess, the depreciation rate, or what you're allowed to, some people call it amortization. So it's 27.5. What does that mean? Where does that come from? The government says your house will be worthless in 27.5 years, regardless if it's 100 years old, 5 years old, 50 years old. You buy a brand new house, you buy a brand new property as an investment property, new construction. For some reason, they sold it as an investment property. You bought it for $275,000. You are allowed to deduct $10,000 a year in depreciation. Now, let me say that again. You bought it for $275,000. One caveat here, we're negating the land value. You have to actually take out the land value when you do that. So let's say you bought it for $300,000 and the land value was $25,000. You can't deduct land. So it leaves $275,000. $275,000 divided by our number here, 27.5, gives you $10,000 a year. So this is lucrative. It doesn't matter how old the property is, anything, you can depreciate all the property. Now, this also works on larger mechanical items. Smaller repairs, I'll get to that, you can deduct, but larger mechanicals, let's say an HVAC unit might be $5,000, $10,000. Yeah, any heating and cooling, anything large that is a big expense, you can depreciate in an accelerated time frame. So instead of taking out 27.5 years, you can take it out sometimes 5. I don't know, the tax code changes. Sometimes it's 15, sometimes it's 10, sometimes it's 5. Sometimes they let you do what you want. I think Trump, if don't quote me on this, but I think Trump is allowing people to take these depreciation, not the home, but the larger depreciation items in year one if you want to, or you can amortize them over 3, 4, 5 years. So an example, if an AC unit costs $10,000 and you can depreciate over 10 years, that means you can write off $1,000 a year. So you can see how this can get powerful. You depreciate the house, you depreciate the new AC unit you put in there, the new AC, the new HVAC. Mostly it's on that. Maybe you put in a new sidewalk or something. Or you have to look at these. Some of these improvements you can depreciate, but I don't know all the particulars of that, so look into that. The next piece, repairs. So repairs. Again, I'm mentioning depreciation. Larger items you're allowed to depreciate. However, repairs you can take in year one. So you have to repaint. It's $2,000 or $3,000. Boom. You take that in year one. That's 100% write-off. You have to fix a window that somebody broke. Boom. 100% write-off year one. Any repairs that you make, as long as you keep track of that on what you're spending, which if you have half of a brain and you're in real estate, you should be doing anyways, you'll have receipts. You don't even need receipts. Just everybody's scared to death. A credit card or your bank account with something on there that says Lowe's or Home Depot and the amount and it matches, you're good. Number 4, local travel. So let's just say to make that little pesky repair, local travel. To make that pesky repair, you had to drive there, right? So you had to drive your own property. You don't live there. Maybe you do if you're in a multi-unit and you live in one and rent the others out, but 9 times out of 10, you're going to live a little bit of ways. You can make a mileage expense every time you have to go there. Every time you need to go to Home Depot or Lowe's. Every time you need to go meet up with a tenant. Every time you need to go meet up with your general contractor. Every time you need to go to a real estate networking event. Every time, as long as it has to do with investing in real estate, you can deduct it, right? Excuse me. As long as it is necessary and reasonable for your business, you can deduct it. So local travel. You go down to the local RIA, go down to the networking group, go to your rental property, meet a contractor, any of that is deductible. Now, how do you deduct it? You can either take it in gas and do that, but the better expense is mileage, which I don't know what it is this year, but it's typically, I'm going to say 55 cents is going to be my guess. 50, that was supposed to be a cent sign. I can't remember if the cent sign goes in front or behind. Is that bad? That's 55 cents, mileage, 55 cents a mile. So I've always taken the mileage just because that factors in the actual wear and tear on your vehicle. If you just take gas and oil changes and stuff, I don't think it comes out to your advantage. So I always take the mileage deduction. You can take one or the other. You can't take the gas and write off the gas that you spent to get around and take the mileage. Okay? Now, oh God, how do I keep mileage? Get in Excel and just take a note every time you go to the property or where you go, and then you can Google it. You can literally punch in, go to Google Maps, home to rental property. That's 6 miles or 8 miles or 15 miles. Okay, I went there and back. It's 30 miles or whatever. RIA, boom, punch it in, do all that. Very, very, very simple. Okay. Number 5, long distance travel. Now, I use this long distance travel. I use this because I live in Houston, Texas, right? I live in Houston, but I have rental properties in Athens, Ohio. Now, conveniently, my family also lives in Athens, Ohio. So when I fly home from Houston to Columbus, Ohio, or to Athens, wherever I'm flying, I write that off. Because when I go, not because I can write it off whenever I want, but because when I go and see my properties. I don't go up there very often. So I go and I poke around, and I meet up with the maintenance manager. I walk through a couple properties. I check on the projects, speak with some of the tenants. And by doing that, as long as you do it, you typically have to keep a pretty good log if you're doing the long distance travel thing, because it's highly audited, right? They don't want people taking vacations and writing it all off. Now, if you work, who's to say if you buy a rental property in California in Santa Monica and you go there and you're actually doing some things, you can use it as a vacation as well and get that paid for. So there's some stipulations on how many days you're there and how much it has to be work or whatever involved. And I'm not 100% sure on all the particulars, but I always write off when I fly. So if you live in Florida and you have a property in Denver or Houston, you can write off those flights, food, hotels. If you drive there, mileage, whatever it takes to get to your rental property. Number 6, home office. God, I loved this one when I actually owned a home. I rent now, but home office. So home office deduction. What is this? If you own a home, I'm going to use very, very, very easy numbers here. If you own a home and it is, and it is 2,000 square feet, and your office where you conduct, just like this office here, where you conduct negotiations, you speak with the tenants, you have a computer, you have a printer, you actually run your business through here. Even say you're wholesaling. If you're wholesaling, you still have an office. If that office is 200 square feet, you live in a house that's 2,000 square feet, that's 10%. You can write off 10% of all the utilities, of taxes, of insurance, of all sorts of expenses that go into that office, right? Now, I can't remember, at one time there had to be a bathroom for the office, so you might include the square footage to the bathroom as well. Again, when you guys get your accountant, speak with them about this. You can ask about all these, but I'm telling you, some people are scared to take the home office deduction. As long as you're honest about it, I mean, if the office, is 200 square feet or thereabouts, just be honest about it. Save all you got your utility bills that you're paying, you save all that and you can write it all off. Number 7, employees and independent contractors, ICs. So employees and independent contractors. So what does that mean? So guys, like I was talking about with these repairs, so when you have a broken window or need to paint, you're paying somebody to do that, right? Maybe you have a handyman. I have a handyman that I use in Athens and one in Houston. So I'm paying him to do things for me. Well, when he goes and he walks a property for me, or goes and gets paint, or changes the locks, or whatever he does, I'm paying him and I get to write off whatever I pay him too. If you have an employee, I don't have any employees, just independent contractors. If I had an employee, I would be able to write off whatever I'm paying him or her as well. So you have an assistant, another maintenance person, whatever it is, you can write off all that. This one, thankfully, I haven't had to use. Casualty and Loss. Ran out of space. Casualty and loss. So, what does that mean? Casualty and loss is basically if something happens, right? There's a thief breaks in. I don't know, to the extent that you can write them off for floods and fires. I'm not 100% sure on how much, what dictates, as if it's a total loss, do you get to write it off? I'm not 100% sure, but if a thief comes in and steals some stuff, or you get some damage from flood and fire, this is what this is for, so you can write that off. Now, hopefully, this is a deduction you're using every year. I think they might catch on. But this is another, if things do go wrong and people always freak out, at least you can save a little bit of money on your taxes. Number 9, insurance. So what you need, what you need to actually qualify for the casualty and loss is insurance. So you have to have flood insurance to be able to get paid, right? To be able to have those casualty and loss things. You need insurance, guys. You have to have, you want general liability in case somebody falls and breaks their leg, or something happens at the property. Maybe you didn't even know about it. It doesn't matter. You want to have insurance. So any insurance premiums you pay are a write-off, okay? And then premium is just basically the annual payment or the monthly payment that you make, right? So if you own a $100,000 property and the annual premium or the annual payment is $1,000, that's 100% write-off. Oh, legal and professional, I love this. The other thing about insurance, guys, while I'm thinking about it, insurance, if you have employees, you can also write off any health costs, any health insurance that you have for them, or, workers' compensation, any of that stuff. Last one, legal and professional. So let's say you guys have a leasing agent, which I do. Their fee, 100% write-off. Let's say you have a property manager. That is me. So I don't have one, but that's 100% write-off. Let's say you use a CPA, which you should. That anything you pay them, 100% write-off. Anything that's professional or legal to help you do your business, say you do some entity structuring. Let's say you set up an LLC, you 100% write-off. Now, that being said, one caveat I will say here. So, I've also been asked regarding some of this, do I need to be in an LLC to write these off? Absolutely not. Okay. Now, some people might tell you, oh my God, he's telling me not to be in an LLC. I have another video about that, I think, but you don't need to be in an LLC. The fact of the matter is, what happens in small, especially if you're just a one-man show or one-woman show, what's going to happen is it's going to calculate everything in the business, and then say the business has a $50,000 loss. It's just going to pass through right to you, if that's how it's set up, right? So if it's sole proprietorship, meaning there's only one person, it's going to go right from the LLC off of your adjusted gross. So if you had adjusted gross income of $50,000 and you have a $50,000 loss from the business, it's going to be a wash. You can get that same exact scenario and tax benefit without the LLC. The only thing the LLC is going to help you out with is liability. Limited liability company. So again, I'm not an accountant attorney. I don't play well on the internet. But what I'm saying is, in my experience, the limited liability companies are going to help you with liability. So if you do something erroneous, have an issue, a wholesale deal goes bad that you're working on, they limit the liability that they can come after you. Now, if it's just you operating, and you do something stupid and they come after you, then they're coming after you. Now, everybody always freaks out about that. Oh my God, they're going to come after. I can't do that. I need an LLC. Sure, set up an LLC if you want to, if it makes you sleep at night. But guys, do not worry. It's like the same thing of, oh, I need to set up business cards. I need to have an email address. I need to do this. All the meanwhile, you haven't talked to one seller. Okay? That cannot happen. Do not worry about, in my opinion, do not worry about LLCs and setting up entity structures and everything, because you don't have anything for people to take. Especially if you're our age, the majority of us don't have anything. We got a bunch of student loans. You can have that. But, a lot of us don't own homes. We don't have, a huge net worth. We're doing this because we're trying to build up to that point. So if you have a lot of stuff to protect, definitely get an LLC. If you're a doctor listening to this, please do that. But if you don't have a lot and you're starting out, I wouldn't really worry about it. Maybe 4 or 5 properties, I'd start thinking about it, right? Depending upon what you do. But as long as you don't do anything stupid and you're within the bounds of the law, it's easy to get a judgment against you or go into court, but it's not that easy for them to win, right? Think about that. So that's my opinion. Take that for what it's worth. Again, just to recap here on all these. Number 1, interest. Anything interest from business loans or from mortgages, primarily mortgages. Depreciation. The actual cost of the house or property depreciated 27.5 years. Repairs, anything you make, paint, broken windows, anything like that. Travel, you got to drive to the property, local RIAs, whatever. I would use the standard deduction. I think it's 55 or 56 cents a mile. Long distance travel. So if you have a property that's out of town, you can deduct flying there. I forgot to mention, you can also deduct seminars if you go out of town to seminars. That makes sense, right? Home office, use a percentage of your income. The employee and independent contractor, if you have those, that's a write-off. Casualty and theft loss, if it's, you have an issue with a flood or fire, you can take a tax deduction. Insurance, all your premiums paid, so including your hazard, flood, all that. And then legal and professional services, so accountants, CPAs, real estate agents, property managers, lease agents, anything like that, 100% write-off. Guys, I know I flew through that pretty quickly, but this was a great question on what exactly you do, and I thought, I need to answer this. So there it is, guys. That's it. There are probably more, especially if you're in your, different states. This is just Texas I'm talking about. I believe most of these apply federally. You might have some more. You might have some less. There might be differing degrees depending upon where you live. So do your own research. I highly recommend getting a CPA or somebody that knows what they're talking about. It'll save you money, and then it'll help you sleep better at night. Thanks, guys. Have a good week.